In this video, we're going to talk about Hershey, HSY, over the course of year to date, down 4%, over the course of 1 year, down just shy of 4%. We're going to hop over to their 10Q and net sales, 2.5 billion, operating profit, $560 million, net income, $407 million. Their gross profit percentage, 45%, operating profit, 22%, net income, 16%. Year over year, they grew their gross profit by 3% and brought that 3% all the way down to their net income. So it's nice to see that they added profits and brought it all the way down to the bottom line. Next up, we have their balance sheet. $446 million in cash. They got $7.9 billion in intangibles, or sorry, $4.6 billion in intangibles, and then $7.9 billion in total assets. Now, to me, this amount of intangibles is very much a red flag for me because eventually these intangibles could get converted over to goodwill impairments, which is considered a loss on the income statement. So you could potentially see this goodwill diminish. So your total assets is going to go down, and then your income is going to go down as well. So it's going to see like your company shrinking. Obviously, most people can look through that, but sometimes it does draw a red flag to investors to see that their intangibles are declining in value, and then it just makes the company balance sheet look not great. The other thing I didn't like too was the cash. That's I personally I like seeing a lot more cash on a balance sheet for a company that's got, 7.8 million in total debt. But so anyway, in short-term debt, they've got 2.7 billion, and in total debt, they have 7.8 billion, and in long-term total debt, they've got like $5 billion. Now I come down here, the cash flows. Cash from operations, $1.05 billion. Capital expenditures was 330 million. Gives them a free cash flow in 6 months of $700 million, annualized 1.4 billion. They also they're buying back or repaying their, long-term debt. They're also paying cash dividends here and repurchasing some stock as well. So all good things there. Um, they the CEO made a comment here that everything's growing, strong demand for their product, um, gross margin expansion, double-digit earnings growth, enabling us to increase their dividend by 15%. So if you're a dividend investor, that's always obviously a good thing to see because you just got a 15% pay increase. All right, so we come over here to the valuation spreadsheet. Ticker HSY, return on invested capital of 22%. That's very good. Down here we have our 3-year average growth rate of EPS, gives us 9. Our forward 3-year revenue growth rate of 5. And then that auto populates into here. And then results, we got 0.42 for the Peter Lynch valuation, and that shows us that we are overvalued. The Peter Lynch price tag, $75 per share. Multiples, got 5 different companies to compare to, gives us an average price of $183.50 per share. Manual PE, we got our market cap, our cash, our debt, cash from operations. It'll take about 22, almost 23 years for this company to equal its current market cap. You know, fairly valued, but close to overvalued. Price to book ratio. Their assets, total assets, 11.5 billion. I did not put the intangibles in here for a deduction, but you know, that is a lot of intangibles that they got sitting on their balance sheet. Total liabilities, 7.8 billion. Outstanding shares, 205 million. Gives them a price to book today of 12. Average 5-year price to book is around 16. PEG ratio 5 and 4.02 for forward looking. Now, in my opinion, this is more for growth companies, not so much for established companies like Hershey. So this is not so concerning to me. Over here we have, I put two in because for Hershey is more of a stable company and mature company. So we put two in there. AAA corporate bonds, 4.93, intrinsic value of $196.50. Come down here, over here, discounted cash flow, weighted average cost of capital gives us 5.08% for our cost of capital. And come over here, perpetual growth rate, 2.5%. I came up with 7% future free cash flow growth rate. Down here, you can see how our cash from operations is steadily increasing year over year, and our capital expenditures are also increasing, but not at a stupid quick rate. However, if you see this is almost doubled, and then this also has almost doubled. Actually, that has doubled. Our CapEx is doubled. Our cash from operations not quite doubled, but it's almost on par with you know, in the past 5 years in terms of, CapEx to cash from operations. Although, you're adding $1.1 billion, you're only adding 200 and what, $50 million of CapEx, so nothing to be concerned about at all. So you got your free cash flow growth here, year over year, growing nicely. Very predictable, which is always good when you do valuations. You don't want something all over the board. Come over here, that gives us a discounted cash flow price per share of $393 per share. Last but not least, Rule 72, current EPS 8.27. The lowest EPS growth rate was 8.9. 8.9 gets plugged in over here. 8.9 goes into 72 8 times. 8 goes into 10 years 1.2 times. So we come over here, we do a one double and plus a little bit more. So I gave it a 17 for a future EPS. And that gives us a fair value of $77 and a purchase price with a 30% margin of safety of $53.93 per share. So down here we have our summary of all of our valuations. It gives us an average price of 180, call it $189 per share, purchase price of $132 per share with 30% margin of safety. So some of the good takeaways of what I saw was 50% increase in dividend. It appears to not have much of an impact from the economy in terms of growth. Investors see this stock as more of a safe haven from poor economic conditions, which is what we'll get to in just a second, which is my opinion as to why this company is overvalued. The couple things I didn't like, not much for cash on the balance sheet. I don't like those, like to see that personally. There's a lot of goodwill that can turn into goodwill impairments and then shows up as a loss in the income statement, and then likely got overbought when everything else was selling off. So we're going to come over to the stock chart real quick. Take a look. Right when things started going downhill in terms of the economy, interest rates are going, recession fears were around, it was right around this point in this range when things started turning. Now, everything else went down. Hershey, damn near doubled in value, which kind of tells you, in my opinion, that investors, instead of they didn't know where exactly to put their money. So instead of putting it into cash, they put it into Hershey. Hershey wasn't the only company. I think General Mills was another company because if you come back, right, here's that range again. Look what General Mills did. Same thing. It went up about 30 bucks a share. Kraft, Heinz, not. This actually wasn't one that did much. So this must be one of those companies that investors didn't find much value in, or didn't find it to be a safe place to put their money. Um, I would have to argue that same thing over here on Hormel Foods. It didn't sustain it, but it definitely ran up in this range when everything started going downhill. So I'm sure there's other, consumer staples out there that did kind of what Hershey did, and investors saw this as to be the best place to park their money while things were going downhill in terms of the economy. And now that things are turning around, they're getting more conviction like, oh, hey, maybe things aren't so bad, and we're going to start selling. So right when that broader market sold off, that's when they started selling off every, right in what, I don't know, a couple, what, 2 months ago, roughly, early August, early or end of July, they started selling off, which would be in this range here. So that's when everybody started selling their stuff. So then I think investors are starting to sell out of this overpriced company. It's a really good company based on its financials, its balance sheet, and everything. I don't see anything wrong with it at all. It's just, you know, it got overbought because of, I believe, because investors were just putting their money into Hershey to find a place to, keep growing their capital in the meantime while everything else, or at least put it in a safe place that might grow it at like a little bit of money because they got dividends and stuff like that too. So now I think they're pulling out of these consumer staples, maybe not entirely, but a little bit. And then they're going to start parking that money into more higher risk, high growth companies, like Nvidia and Tesla and Apple and um, bigger name companies that are proving to not be impacted by the economy anymore. Plus, you got the AI hype too, so they want to take their money out of these, boring names, I guess you would say, and put it into more of the exciting names. So that's my take on Hershey. I think Hershey's a good company. I do think it's overvalued because of potentially like what I just said, that investors were piling into it to put their money into a safe place. But yeah, that's what I think. That's my take. So let me know what you guys think. I'm always curious to know. Also, if you want any stocks valued, drop those down below as well. And if you found value in this video, please like and subscribe. That'd be great. But that's it, and we'll be back tomorrow with another video.